This morning, General Catalyst CEO Hemant Taneja is here out with a new book. It's called The Transformation Principles: How to Create Enduring Change, and it outlines a new era for capitalism beyond Silicon Valley's old move fast and break things adage. Joining us right now with more on this, AI, all things in the tech realm. We're going to get into what's going on with HB1 visas and so many other things. The man who wrote that book, Hemant Taneja. He's the CEO and managing director, or managing partner, I should say, of VC firm General Catalyst. And by the way, I should say, you say that the book, or I don't know if you dedicated it this way, but that Ken Chenault is responsible largely for a lot of the things you're talking about in this book.
Yeah, Ken joined us, first of all, thanks for having me. Ken joined us about 7 years ago at GC. And we've been on this journey together on how to think about the role of technology in society, the kinds of enduring companies you build. And he's been an amazing mentor, so I decided to dedicate.
And so what's the distinction? This idea of move fast and break things has been the sort of adage of Silicon Valley for a long time, and you say that's not the way.
Well, let's take a step back. So if you think about the last 5 to 7 years, what has happened in the world? We're having lots of wars, so peace is not really there, not available to us. If you think about the pandemic, we've got sort of broken healthcare systems. We've got an energy crisis, especially in the world of AI. And then you've got AI, which is a technology leverage that can actually impact these industries. And so it's an opportunity to take a step back and think about what these services are going to look like for the next 100, 200 years in society. And you can't rush and focus on the traditional Silicon Valley mantra of, hey, let's just grow these businesses fast and deal with the consequences later. It really has to be a lot more intentional. So a lot of what the book is about is, what are the key principles, what are the key mindset and mechanisms with which you should be thinking about building these companies?
So here we are in the AI moment. We saw NVIDIA is announcing, $100 billion into OpenAI.
Yeah.
Does this make sense to you?
Yeah, look, I think, so if you think about the AI opportunity, first of all, the AI opportunity is the energy opportunity, because there's so much energy generation that needs to be accomplish over the next 20 to 30 years. How do you really go about doing that? Then the question is, how do you actually create these compute clusters that are going to drive productivity? Because it's essentially taking services and melting them into productivity. Right. That's what AI is going to do. That is a massive opportunity. That's trillions of dollars. And so the amount of investment going in, if you think about the value it creates on the other side, the numbers are staggering, but the math is actually compelling.
So but in 10 years from now, are we going to look back and say this was the golden age? Are we going to say this was a sugar rush? Are we going to see, lots and lots of winners? Are we going to see a bunch of winners and a lot of losers?
First of all, there's some patterns from the past. We're going to look back and say there was a period where we felt like we overbuilt capacity. This happened with the CLEX, for example, in the internet days. So that's going to happen. But then we're going to grow into it. So first thing is, there's going to be some bumpy stuff in a couple of years when you feel like there's overbuilt, but then you grow into it. But this is going to be some huge winners, and it's very unclear how many of the companies built today are durable or not. Because as the models get stronger, so much of their capabilities start sort of seconding what a lot of these new companies are building. So the question is, where is the value going to reside? Certainly in the models.
Yeah, put that in perspective for us. Use an example of a company today.
Well, so there's, take coding today, right? I mean, if you look at Anthropic, we're investors in it, a huge part of their growth is in bringing cloud capabilities and automating technology development. Well, so as coding gets more sophisticated, it gets easier to build software. So there's these companies that are getting built on top of these models that are actually negative gross margin. They don't really make any profit, but They grow really fast because they're compelling, easy ways to use it. Well, are those companies going to be around? Or are those features going to get subsumed by these models?
But you're not questioning the models themselves.
Models, I think there's going to be enough of them that are going to be durable.
We've been discussing this morning the idea of vendor financing, in that here you have NVIDIA is investing in OpenAI. It cares about its success. And yet a lot of these businesses, including OpenAI, don't yet make money. And so you need to, all of the chip makers, to some degree, need to prop up or keep all of these companies going long enough that they can get to profitability so they can turn around and keep investing. I think that is a potentially great game and also a dangerous one.
Well, first, there is round tripping there for sure, because today a lot of the margin does accrete at the chip layer. So they're sort of taking that margin and saying, hey, let's sort of accelerate the investment in the industry, because it's beyond what venture capital could do, for example, right? The main thing is, though, if you look at these models, they all do have applications that are at scale and with good margins. They're just investing a lot in this AGI pursuit on top of that.
You're saying if you just stopped...
If you stopped it, they actually have businesses. They do have businesses that I think are going to be durable. But this pursuit of AGI is the thing that keeps attracting more and more dollars because...
I was going to say, durable to the point that the valuations make sense, the private valuations on some of these things?
Look, I mean, if you think about the growth of these businesses, I mean, Anthropic, for example, went from less than $1 billion run rate last year to something that's going to be 8 to 10 this year. When was the last time that happened? Right?
I don't see any way we go from move fast and break things to planning for 100 to 200 years. That sounds crazy to me. And I think advances, and we know this now, advances, they're not taking longer between quantum leaps. The time between major advances is shrinking, and we've seen it. And people even talk about a singularity occurring when machines know so much that we can't even predict what it means. So
let me say, I think they're two separate things.
I just don't see how. I mean, we're talking about changing from quarterly to 6 months, and people won't even do that. We may go to weeks.
Because the first thing is, I think technology is moving really fast, which is your point. And so the question is, how do you build this next generation of companies that avoid technology obsolescence as a risk for those who adopt them?
Because half of them are gone already. Novell, digital, they're not even around.
That's right. So I think if you look at companies like Palantir with this forward deployed engineering model, a lot of that is it sort of insulates you from technology changing. My point in the book is actually about how do you create these systems? What is the healthcare system going to look like? What is the energy system going to look like? What are these supply chains going to look like that are actually resilient? That to me is about the innovation partnerships, the ecosystems of companies that need to be created, and how they interoperate. Your point is actually about each of these companies, what is the durability given technology is moving so fast? I think they're like sort of two separate dynamics in how you set these ecosystems up.